What are fixed and fixed index annuities? That's what we're going to talk about in today's video, so please stay tuned to the end, because at the end we're going to talk about where rates are right now in annuities, and a lot of you might be interested in that. My name is Jamie Pripp, and I'm excited to have with me today Jennifer Wick, who specializes in annuities and annuity products. And we're going to learn about annuities and who they are a good fit for. So welcome, Jen. Great to have you here. Maybe just introduce yourself real quick.
Yeah, you bet. Thanks, Jamie, for having me. Yeah, my name is Jennifer Wick. I come from an annuity background, particularly. I currently work with IFC National Marketing, where I represent about 30 different insurance companies that allow me to work with insurance agents and financial advisors to help find the best annuity solution for their clients. So I help them with just education and finding the best fit for each individual person that they're working with. Prior to that, I've spent some time working at Allianz Life Insurance Company, both in operations and sales as well, with fixed indexed annuities as well as variable annuities. And then I spent some time working with a couple of financial advisors. So I've seen things from all different perspectives within this industry, and it's really helped me, do my job to the best of my ability.
Right, great. So you said before we started the video that last year was kind of a banner year with annuities just because of the interest, and I'm assuming a lot of that has to do with market volatility and interest rates. Is that true?
Yeah, I would agree with that. So yeah, to put things in perspective, last year was a record year for annuities on a national level. Annuities were north of $310 billion, and that's all annuities, variable, fixed index across the board. So if that tells me anything at all, people are interested in annuities, they're buying annuities, and understanding better what annuities can provide than maybe what they once were.
Sure. You said something really fascinating to me in one of our talks and meetings about doing this video today, and that is you regularly run across people who have a lump sum of money somewhere that they don't know what to do with, or even that they've forgotten about.
Yep. Yeah, it happens more often than you'd think. A lot of clients don't even know where some of their accounts are at or where some of their investments are at. A lot of people change jobs and don't realize that they had a 401k that they can move over to an annuity or another sort of an investment vehicle. So it is kind of interesting when you do sit down and have conversations and find out that there are assets that are just lingering out there in the world, and doing things that maybe aren't best for what the client's needs, wants, or goals are. Yeah. And that there are other opportunities that we can do just what they're looking for if we just educate them on what is out there and what we can do and how we can transfer them over without them paying taxes on those monies. Yeah.
My oldest son got married last year and has a different job, and we're still getting statements on a 401k that he has set up that he's probably already forgotten about.
Absolutely. Yeah, you hear that quite often.
So talk a little bit about how annuities differ from where people maybe traditionally think about putting money, like a bank.
Sure. So, annuities in general, I think, have some negative connotations. And I think that boils down to just a lack of education and ignorance, if you will. So many of the public is very familiar with their local banks and what their local bank can provide, such as a savings account that you get pennies on your dollar, right? CDs, right, where you can plug your money in for a period of time and you're going to get a fixed rate of interest in return. But if you pull that out before that agreement has been met, you're going to pay a penalty. Well, annuities are going to be very similar, where you're still going to have that protection. You're not going to lose anything, just like a savings account or a CD. So never going backwards. There is no cost or fee involved unless you were to pull that money out sooner than you agreed to, just like a CD at the bank. But with an annuity, being that safe money alternative investment, is going to provide you with a fixed rate of interest or a guaranteed rate of interest that in a lot of cases can beat what you can get at the bank. And in addition to that, gives you a tax deferral on the interest. So unlike the bank, with the bank and its savings and CDs, you're going to pay interest on any of those earnings on an annual basis. Whereas with an annuity, all of that interest you're earning, you're not paying taxes on until you start to withdraw those monies.
That's funny you bring up taxes, because obviously this week is tax week for a lot of people. I was helping two of my sons yesterday file their taxes, and it's not a fun experience for anybody.
No.
But there are some tax benefits to annuities. Why don't you talk a little bit about those tax benefits?
Yeah, absolutely. So yeah, and how timely, right? Like you said, tax time is right around the corner, and I just filed mine, and I'm not excited about what I'm having to write a check for. But nonetheless, yeah, so in terms of the tax benefits, touched on that just briefly. So when you put your money into an annuity, you can always take taxable money and move it over to an annuity on a tax-free basis. And you can use different types of money, such as pre-tax dollars, right? That was maybe came from a 401k or an IRA, or you can use post-tax dollars that are sitting in your savings account, or in most cases CDs. And you can move that into an annuity on a tax-free basis, and then all of the earnings that those monies will earn while in the annuity are gonna not be taxed at ordinary income tax levels until you start to withdraw them. And when you start to withdraw them, you can withdraw piece by piece, so you can spread out the taxation on those earnings rather than paying it all at once, if that's how you choose to do so. However, if you pull it all out at once, it will be taxed at ordinary income tax levels.
Sure. The other thing that you've mentioned to me before is that annuities have changed over the last 20 to 30 years. And they aren't the same as they used to be. Can you explain that? Why that would be?
Yeah, absolutely. Well, I think the public has spoke, as well as insurance professionals and financial professionals. Annuities, once upon a time, they were built to really replace income in retirement. So they were designed to create a paycheck for a fixed period of time or for life only. It was a contractual settlement arrangement. Now, annuities, you can still do just that with them. However, there is a lot more flexible, beneficial, advantageous ways to get income from annuities and create like your own self-funded pension, if you will. So you're going to see lifetime income benefits, where you're going to get a paycheck for as long as you live, still participating in the market return, still able to access additional money if you need to, still have a death benefit. There's also long-term care benefits and features that are built into annuities that a lot of people don't understand. So if you happen to go into a nursing home or need home health care, in some cases they'll give you additional income from that annuity to help you pay for those costs. You're able to take money out at different periods of time. Once upon a time, the flexibility in terms of liquidity wasn't there like it is today. So a lot of value has been added to annuities that wasn't once there.
Sure. And we already touched on this once, but there is a lot of volatility right now, and people are, it seems like, a little bit more concerned about the next couple of years and what's happening with our economy. So do you talk with people who have that sense as well, that, hey, we feel like things are uncertain right now in a way maybe it hasn't been in a while? It's debatable whether, what the next 6, 12, 18 months is going to look like. So do you have conversations with people about that as well?
100%. A ton of uncertainty is out there, and for all the reasons that we're seeing. If you've turned on the TV and watched the news, if you look at social media and you see what's going on with the volatility in the marketplace, inflation has been at an all-time high. They're finally starting to curb that, although I don't know that I'm seeing that when I go to the grocery store or go to the gas pump. However, a lot of people that are currently in retirement went through 2008. That definitely stressed a lot of concern, and for clients to look for more safe money alternatives and push more money into annuities. That's where 2008 had a record-breaking year in annuities. Then we went on this bull market, and we were in a very low interest rate environment up until now. About this last year, you've seen interest rates on the rise, ultimately to try to curb inflation. But with that interest rate increase, it's also translated to annuity rate increases. And people with the uncertainty are looking for a place to go with their money that they're trying to protect. It's like, listen, we've worked our entire lives for this money, and now we're getting closer and closer to retirement, and we want to know that it's going to be there for us in retirement. And there's only certain vehicles that you can use to protect your assets outside of the bank, a savings account or a CD, and fixed indexed annuities are another place where you can get that protection like you can in the bank, but you're able to get more earnings than what you're able to get in the bank.
Sure. The other thing that you said, which was interesting to me because I never really thought about it, is that sometimes people have an old annuity that maybe isn't performing as well as it could be now. I shared with you that I have a 93-year-old, soon to be 94-year-old grandmother who has a rate of close to 6%. But some people have annuities maybe that they got several years ago that aren't performing as well as they could be now, and there are options to move an old annuity to a new annuity, correct?
Absolutely. So that's a huge opportunity, especially for insurance and financial professionals, to talk to your clients and look at what do they have existing. Chances are with any old annuities that they have, unless they date back to 20, 30 years ago, the rates that they're probably getting, from the last 10, 15 years are not going to be what we can provide for them today. So I would definitely encourage you to, talk to your clients, or these, clients look at what you do have. Do you have old annuities? And if so, talk to your insurance professional, your financial professional. Look at those statements and see what kind of rates are you getting? Is it out of surrender? Is this still doing or going to do what I wanted it to do maybe 10 years ago? Chances are things have changed as far as a personal environment, right? And what you were looking for then versus what you're looking for now. And then in addition to that, what these annuities are offering now in terms of rates and index options and liquidity and income riders and things like that, we can move that on a tax-free basis to a newer, I guess, annuity, if you will, and get them in a better place ultimately.
Sure. Just talk briefly about someone maybe, or a situation, a case, whatever you want to call it, that you worked with recently where you were really able to help a client, be put into a position like maybe they hadn't even expected they would be able to do that.
Yes, absolutely. Great question. I'm glad you asked that. So here's something I'd love to privy everybody to is pensions, of course. Pensions have become, I guess, a way of the past. However, pensions are still out there. They're still available for people that have had them for many of years, and they're coming up on retirement. With a lot of pensions, you have the ability to take a lump sum or take a payment plan. And when I say payment plan, I'm talking about annuitizing. I'm talking about entering into a contractual payment arrangement that you cannot change, you cannot access. If you take that payment and you pass away 2 weeks, 1 year, 2 years into it, anything that's left is gone. Well, alternatively, there's this lump sum option. And a lot of times people will see this payout option versus the lump sum, and they see this big number and they say, I want to take that, but they're not educated on what will happen if what I just said, they pass away, or if they need additional money. They have no access to that. This is what it is. This is your payment. This is what you get. That's that. Whereas we have taken these lump sum options instead of the paycheck, and we can roll that tax-free into an annuity and add an income rider onto that. And in a lot of cases, people don't necessarily need that income right away. So if they can defer income for a year or two, in a lot of cases, an annuity can beat the income they were gonna get from the pension, number one. Number two, they still have a death benefit. Number three, they still have market participation. And number four, they have flexibility. So if life changes, which I think we all know that it does, you can still get access to that money if you happen to need it.
Sure. That's awesome. We'll just close by saying just a little bit about where you see rates are, where they're at right now, generally speaking. I know you can't say, there's different types of products available, but where are you seeing rates right now?
Mm-hmm. Yeah, and to your point, annuities are definitely not a one-size-fits-all. It's really important to understand your own situation or your client's situation and what their goals are for that particular bucket of money, so we can make sure we find the best solution for them. In terms of rates are going to vary across carriers, across product line, across duration of the product. So right now, for example, we have 3-year guaranteed rate annuities that are hovering around 5%. Okay. And that number is ever changing because of economically where the market is sitting. So we're going to probably continue to see that change, but I don't think it's going to change and necessarily go far backwards from where it's at. And then on the other side of the fence, you have your index annuities. That all index annuities have a fixed rate that they pay, and those are between 4 and 5% right now. But in addition to that, they have index options that you can track. And what that allows you to get is, let's say the S&P 500, that's typically built into every index annuity. Sure. You're going to see caps at 9, 10, 11% without taking on any other risk. So you're not going to go backwards. You're not going to pay a fee. You have the ability to track an index and get up to double-digit returns with no risk. So it just depends on what the client is really looking for. And that's where I come in. I work with, insurance agents like yourself and financial advisors to help educate them on annuities and help them find the best solution for their clients based on their individual needs.
Sure. Well, awesome. Well, thanks for doing this again.
Yeah, thanks for
if you
having
do
me.
have questions, you wanted to learn more about fixed annuities or fixed index annuities, we'll leave our contact information in the description of this video, and you can certainly set up a meeting, and we'd love to chat with you, no obligation chat about what your options are. So thanks so much for watching. Have a great day.